Let's do one thing. We'll go across to George Joseph from ASK Investment Managers, who joins us now to discuss market fundamentals. George, thanks very much for your time here today. You know, a pretty uncertain macro environment with what's going on globally. We're seeing what's happening to the oil prices as a reaction, but domestically, at least, there is some comfort. Corporate earnings have been pretty decent so far. We've got a good bunch in banks and, Maruti, Bandhan, all of these numbers today also looking pretty good. In the current environment, with the correction that the markets have already undergone, what is emerging as pockets of opportunities? What are the sectors you'd bet on that you think could break out from here?
Thank you. Thank you for having me here. And, it is a very interesting time in markets. If you look at crude has been the biggest spoil sport, or from an India context, it has been moving up. The Strait of Hormuz, everyone is aware about, it is creating the news flows. But, what we tell our clients is that uncertainty, the source of uncertainty can keep changing, but the fundamentals don't. So the fundamentals of Indian market is pretty strong from a long-term perspective. There is no other growth market I can think of which the GDP can double in next maybe 7 to 10 years. What we have gained as GDP over the last maybe 78 years since independence, which will get added in the next 10 years. That's the biggest argument for equity. Now, looking at the opportunity after these corrections, what we feel is cyclicals will do very well. And that has been our call since what we have been communicating to our investors consistently for the last 1 year, be it banks, auto, engineering, capital goods, real estate. And, all these sectors will do very well in an inflationary environment. And that is what will drive from here, also looking at the way the energy is priced in. And we are quite bullish on those sectors. And especially the defense sector allocations globally is going up significantly. From 2026 budget allocation from US point of view, it's $1 trillion defense allocation, which is like a massive change and which will drive the global environment for defense allocation. So we believe that, defense as a sector will do very well as well.
George, the other big theme that has been the highlight of April has been power. The record power demand that you have seen across the country, stocks going up 30, 40, 50%. Do you have exposure to the power sector? And if so, where do your preferences lie? Be it the power financiers, the power discoms, the power generators, or even the ones that are supplying infrastructure to all of these power generators?
Very interesting question. It is in the light of the artificial intelligence and, the requirement for power increasing substantially across the globe. The entire power value chain looks very interesting to us. We have power gencos as well as, power sector financiers, most of them looking very, very attractive, especially, mind you, the kind of demand pull which is going to happen in the artificial intelligence led data center capex in India, and the demand for power is going to disproportionately increase in the next 5 to 10 years. So we are of the believer that we need to play the entire value chain effectively, right from the financiers to power generation companies, the suppliers to the data center electrification requirements, and also looking at the distribution companies. So the entire value chain looks very interesting. And, mind you, US, the power infrastructure is a 50-year-old, and, they are also in the mood to revamp the entire power infrastructure in US to accommodate the massive demand pull which is coming from the artificial intelligence led requirements. And the same thing applies to India as well. So we like the capital goods sector plays, which is beneficiaries of these data center capex, and which is going to from 1.7 gigawatt in CPUs to 3 gigawatts by next 4 or 5 years. And also the GPU demand is moving up, and we believe that whatever we understand from the experts, it will be around 7 gigawatts by 2030. So the demand in the data center related capex, specifically artificial intelligence, keeping in mind the power sector looks extremely bright to us. So we have exposure to that.
All right, we take that point. Just as we were speaking, look at a couple of these stocks which are surging right now from the QSR space. We have Sapphire Industries, which is up 9%, decent volumes backing that stock. And because you have an impending merger with Devyani is up around 4% as well. So Sapphire is up around 10%. Devyani Industries is the other one, which is up around 4.5%. Devyani International, that is. And that's largely because, remember, yesterday Sapphire reported its numbers. They said that the KFC business actually saw the fastest growth in the last 8 quarters. The overall SSSG was fairly strong for them, and this despite the LPG-related crisis. And ahead of results, HUL is also at the high point of trade, up around 1.5%. The street expects mid-single-digit sort of revenue growth. So far, the trend in consumer companies has been that all of them have beat expectations. So, George, that exactly is the question. All the staples companies, the discretionary companies, they're giving better outlook here, but valuation-wise, they're not particularly cheap. And as we go forward, cost headwinds and the perhaps impact of an unfavorable monsoon on demand could also impact their business performance. Do you think there's still investable ideas right now, or maybe stay away?
Yeah, so from the current context, the food inflation is going to be significantly high, is the expectation with the El Nino impact, which is being talked about. But, the way I look at it is the fundamentals and valuations are very, very important. These companies are very good companies, balance sheets are clean, so on and so forth, therefore they will attract investor interest. But from a cycle perspective, 2020 onwards, we believe that, it is a complete reflationary trade and the inflation going up. And as we speak, US interest is crossing 5%, 10-year GSEC, all those things are the situation what we are having. And the global growth per se is expected to be lower, as per the IMF reports, it is going to be lower than the pre-COVID era of, and it is quoted to be 3.1%. And if the Strait of Hormuz problem is going to get escalated, what we believe is that the world growth can struggle further. So in that context, looking at the cyclical sectors, energy proxies, as well as commodity proxies will be the big play. And they are the ones which have been doing well from 2020. And we think that, that is the segment of the market which needs to more care and attention and, where the investors should put money rather than going into staples and near term with the food inflation around the corner and people talking about it, there could be case to play a trade over there, but we don't think it is making sense from an overall context.
George, thank you so much for sparing time and joining us today with your views on the markets and of course pockets of opportunities as well. Take a short break.